Stop share. Start video. Okay. Good afternoon. Sound check. Test 1, 2, 3. How are we doing? Sean Barrett. What's up, man? How you doing?
Doing good. How are you doing?
Outstanding. Let's see here. Start the custom live feed. Go with that. Admit. Got it. Close that off. Turn that on. We are live. Oh, there's always good when the guest shows up. Admit. Join. Okay. Kenneth, is that you? Kenneth Summers? Okay, wait. I'm not allowed on the whiteboard. I'm not going to allow them to unmute themselves. Kenneth, is that you?
Hello. Hey there.
How you doing?
I'm doing well. Yourself?
Good. Do you have a camera?
I do, but I don't think I can access this right now. I'm kind of busy. I'm multitasking.
Okay. Is this Kenneth Summers?
No, I think that's a different Kenneth.
Oh, wrong one. Okay. No, our guest today is also by coincidence. Okay. Sorry to bother you.
No problem.
Kenneth. I guess she's not on. Kenneth Summers, if you're there, hit the chat box. If you're under a different name or something. I know we confirmed with you today. Not seeing you, huh? Okay, I guess we'll start without. Let's see here. Just 1 second, technical difficulty. Where is our guest? There's Dave Weideman. Text, okay. Canada. Which meeting? Let's go back. Okay, so you invite someone out here as a guest, but I don't see him. I'll assume he's having some technical difficulties. Let's talk about real estate today. Let me get this thing launched. Okay. Wow. Okay, reload. Okay, looks like we're live. This is Bill Gross, the LA probate expert, and this is our Tuesday real estate investment Zoom call, realestateInvestingZoom.com. We get together every Tuesday at 3 p.m. Pacific time, 6 p.m. Eastern time, and everything in between and before and after. Talk about all things real estate. Let me get myself here as the spotlight. There we go. Hey, everybody. So I had a guest who I thought would be on today, but I'm not sure if we got our signals crossed or what's going on. So we'll make a participant, but I did want to talk today about what's going on in the marketplace and why I think we're really at a transition moment. And what I mean by transition here, who besides me has played basketball or soccer or any sports at a high school level or competitive level? So when you're coached up in basketball or soccer or imagine football, I guess football as well, one thing you're taught is that the key is on the transitions. When you're going down court, let's say, with the ball in offense, and you turn over the ball or you're shooting, you gotta get back as quick as you can. That's called a transition game. And if you're in defense and you steal the ball or rebound, you want to turn immediately and run down court, try to beat your opponents down. That's a transition going the other way. And I think we're in a transition. We're saying, who besides me thinks we're in a transition right now in our real estate market? Raise your hand or put me in the chat box or yes. Or unmute yourself and jump in here, family style. But when hand raised, great. So here's what I'm going to show you guys a graph. And I think to me, you just got to pay attention to the most important statistics. And I think there's two important statistics in our marketplace right now. One is unchanged is inventory. There's very few homes available for sale, which has caused prices to go up and will make it harder and harder to do transactions. And one of the reasons why is the rates. One of the things that caused people want to buy houses was the low rates that we were experiencing. And I just want to kind of show you guys, I talk about this on my Monday morning real estate weekly video. Got it. Okay, so the live stream shut down. That's weird. Okay, can you guys see that? Okay, so this is the 30-year fixed rate for the last year. And what actually I think is more interesting is you go to 2018, before the pandemic, rates were at 5.5%, they go down, they go up, they go down, they go up. For last, pre-pandemic, 2010, you can see where they've been for the last 10, 12 years in this range. And when the pandemic hit on or around, it started coming November, December, January, February, March, rates went from 4s to really the bottom dropped out. And the reason why was the world assumed the economies would fall apart and money flooded where people could save it. One place they saved it was gold, that went up a lot. One place they could save it was the stock market, that went up. One place was cryptocurrency. The government printed money, gave out money. But one safe haven has always been US bonds. And mortgages, most mortgages are backed by the full faith and credit of the United States government, which is you and me, taxpayers. And post-pandemic, when everybody was expecting the economy to grind to a halt, rates went down as low as a low 2.71%, 2.75 effectively. Now, starting in 2022, really November last year, rates have been on an increase. So take a look at, if we were to change this number to 2022, the end of the year, we're at 3.2, and now today, we've been going up to 5, 5.5, back down, 5. We've been in this trend for a few weeks. On Friday, we jumped from 5.25 to 5.55. Always bad when you end the week on a new high. And then Monday, I'm sorry, that's not true. Monday, it ended at 5.8. Friday ended at 5.85. So it went up. We broke from 5.5 up to 5.85. That was a bad sign. Monday, when the stock market's crashing, you might have thought rates would go down as many people sell money in stocks, put in bonds. The opposite, rates went up to 6.185, new high in this whole time period. And today they stand really at 6.28. So we're 5.5 is a high, 5.85 is a high, 6.1 is high. Every time you hit a new high, there's people say, well, that can't possibly last. So it kind of stalls and goes back. And you can see from the pandemic period, everything's been below 5%. We're at a new high. And you really need to go back to 2008, actually, to see where we were close to these rates. 2000, is when we do it. To go higher than that number, you have to go back to 2008. So the last 14 years, we're at a 14-year high or low in terms of, depending how you look at it. And the worst part is that this has been on a straight upward trajectory with no real slowdown for the last couple of weeks. Now, I tell people I have a crystal ball. Truth is, I have a crystal ball. It's right there by the subscribe sign, but it doesn't tell you anything. I think that's a hysterical joke. It cracks me up. I don't know about you guys, but it always cracks me up to say that. But I don't know where rates are headed because we don't know what the future looks like. Will there be a war will the Ukraine and Russia war settle out, or the worse war? Will there be war in China and Taiwan? Will there be war in the Middle East? I don't know any of those questions. Today, I do know the rates are 6.28. It's higher than 6.1. It's higher than 5.85. It's higher than 5.5. That I know today. And so when you read the news, and here's an interesting thing you might want to do. If you just go to YouTube, and I'm going to do this as anonymous. Let me change this to, I'm going to say incognito. If you go to youtube.com and put in real estate, I'm going to share this screen. I can't share it because it's not incognito. But when you do that, The answer is you gotta don't buy property till you watch this. It's happening, biggest crash ever. And if you filter to, let's say, this week, don't buy property, watch this. It's happening, the biggest crash ever. Serious warning to investors. Real estate just got more expensive. How bad is it? Condo prices on the brink of sinking. Our price is about to fall. It's all bad news. Now, I don't believe, like last time, I don't believe that values are going to continue to go down. I'm sorry, values will go down overall. Because unlike last time, there's nothing forcing sellers who don't want to sell. There's nothing forcing them to sell. What do I mean by that? Last time people had 30-year fixed rate mortgages, they thought, I'm sorry, they had mortgages they thought were 30-year fixed, but really they were adjustable. There were negative amortizing loans where the loan balances went up. And then when those stopped and pushed the market up, there were new loans where people didn't even qualify. They had an adjustable that was going to change in 6 months or a year. And they're told, don't worry, just keep refinancing out of it. And eventually, once the music stopped, you could refinance out of it. People owned properties that they couldn't afford, and they had no choice but to sell the properties because the rents didn't cover it. And they sold one, then two, then three, and then the whole thing felt like a house of cards. That's not today. Anybody who bought a house today has a 30-year fixed mortgage. I should say 90% of them. That's not going to go up. And almost anybody who bought a house today qualified to get that mortgage. They have the income for it. They put some equity in the property. They're not going to let it go. So what's happening is there are sellers who were going to sell and buy another house. They're going to cash out in LA, sell a house for $1.5 million, take $1 million, put in the bank, put $500,000 down on a $1 million house in Florida. But they look at that mortgage in Florida and go, well, it was 3, now it's 5.5 or 6%. I'm not going to do that. So there'll be sellers now who were going to trade up, trade down, who are not going to, or even trading up. They own a house in West LA for $1.5 million. They want to buy a $3 million Beverly Hills property. They're going to sell their house, take $1 million cash, put it down, borrow $2 million. The mortgage payment just doubled. So trade up buyers or sellers who are going to trade up aren't going to trade up anymore. So it hurts the buyer at the high end, less buyers for them. It's going to hurt, but it's going to hurt the middle market because there won't be inventory for those buyers. So those prices really can't go down. They don't go down unless somebody wants to sell at a lower price. So for all the fear about prices, the thing to focus on is cash flow as an investor. What I would tell you is if you have a good market where there's a good job, good economy, and you have a building where people are paying rents and good management team that will continue to get those rents, the property won't go down in value. If it does, who cares? You're not selling it because you're collecting the rents to cover all that. And so one of the safest havens to invest money in this market, and place I've been putting my money for the last couple of years, is cash flowing real estate. Not development deals, not to say you can't make money there. I'm just not that smart. But the problem with the development deal is you have to assume you can finish the project at a certain time period and sell it at a price that will qualify. Now, some development deals are done where they develop a deal and it ends up being a cash flowing piece of real estate. Great. But I don't know if it's going to cover the price a year from now. Rates continue to go up. What I do know is if prices are going up, my multifamily investment, they're still paying rent. Their rents are going up. That means I'll have more money, not less. So that's why I really focus my personal investment portfolio on cash flowing residential real estate in markets where I have solid demand. In my case, I like Texas and Florida. I also go there on business once a year or more. So I want to go to markets that I know and can check up on. And I mean, a lot of people, a lot of great properties in other states, nothing wrong with them. I should have a reason to go there. And I would rather buy property where I can go than where I can't go. So on this call, we're going to start having more different syndicators and investors, both talking about deals and companies where you can invest money to get involved. Personally, I've studied a lot of the subject. I went to Grant Cardone's real estate boot camp. I invested with his company a little bit. And so I got comfortable to make a bigger investment than the bigger, to feel comfortable to invest money in these cash flowing. I don't buy them on my own. I'm not buying an apartment building. I'm investing $50,000 or $100,000 with proven teams that have property managers, have construction teams, have a plan, have resources. They're just taking my money and giving me a return on my investment which is a very reasonable return for what I do. So I got a question from Dave. Interesting. Dave, thanks so much. Dave Ornament. Nice to see you always. In addition to sharing his contact information, do you believe there'll be stagflation in our future, persistent high inflation combined with high unemployment and stagnant demand? I don't know about the future. I know what's right now is I know we have inflation today. I know when I drove on Thursday and Friday saying I need to get gas by Sunday because I was going to go out to a trip to the valley and come back and then take my wife and go towards the airport and come back. I knew it was a quarter tank. I knew I had to get gas. I'm driving around Thursday and Friday seeing gas at $5.75. I ended up paying $6.47 on Sunday. So I know there's inflation. I know I want my wife to buy food and beef. I can't believe what we pay for steaks and we pay for fish and such. So I know we have an inflation now, and I don't see anything stopping it. If the obvious core, just like a monopoly, when you keep adding money into the economy, everything goes up in price. There's no way to stop that. And we seem to be doing that. Regards to politics, all politicians want to just spend more money. There's a local politician. I helped host a election event for our city council here in Los Angeles. And one of the candidates who ran, but he lost. He was advocating that we need to give out $1,000 minimum income to every citizen. In Los Angeles, we've actually started this. We have a pilot program. We're in LA. We're now giving $1,000 a month to a certain number of people who sign up for it. I don't know the rules behind it. I'm not getting it. I don't really care. Seems like a crazy idea to me. I mean, it seemed insane to me. But I asked him, I said, well, but he said he supports it at the federal level, not locally. I said, I don't understand. If you think it's a good idea, why wouldn't you have us local LA taxpayers support the idea? It seems you believe in it. Why wouldn't you do it? He said, because the local government can't just print money. The federal government can just print money. When you have people like this, and he's an attorney and he works for a nonprofit and he's running for city council, he lost. When you have people who believe, well, all the solution to the problem is that we can just print money, I don't see any pushback on inflation. I don't think anything's stopping inflation. And one of the core inflation causes is a high energy cost. I don't see any. In LA, my friends are proud that we can't drill oil in Los Angeles anywhere. We have oil wells in LA, and they're trying to get them all shut down. And then we can't drill in Alaska because there's nobody there. So we can't drill where there's people. We can't drill where there's no people. The only place we can drill is where there are countries who are committed to killing us. Russia, Iran, and I guess Venezuela's communist country now. Went from wealthy country in my lifetime to communist country. Enemies of ours. Our government doesn't even allow Venezuela to come visit the Summit of the Americas here in Los Angeles. So I don't know, without saying, but now you might say it's a good thing gas is high, we should drive less. I'm not going to say good or bad, but what's clear is prices are going to go up, and I don't see anybody trying to stop it. And I don't see anybody really advocating for pumping more oil to cause those prices to go down. We had experience the last few years of fracking caused natural gas prices to go down. There was downward pressure on inflation, and the political party in power wants to eliminate all that. So I don't know about the future, but right now, clearly there's pressure to raise prices more than we have even now. I don't see anything slowing that down. So I'd prepare for an inflationary time, whether it's stagflation. Is it going to hurt the economy? Will there be people lose their jobs? I don't know. Maybe. You see already companies are starting to lay people off. Mortgage companies laying people off. Real estate companies laying people off. Maybe this is the tip, the very beginning of it. I don't know. What's true today is what I watch. I wouldn't want to predict the future. Okay, a couple hands up. Let's make this interactive. Hector Aguilar, welcome to my colleague from San Gabriel Valley. What's going on, man?
Hey, how you doing? Always a pleasure to be on board. Can you hear me clearly?
Yeah.
Wonderful.
Dude, that's a white shirt.
My question to you is, I know that there's been a lot of, I know, and my background is white too,
Beautiful.
so I can't really, it looks like my head's floating, right?
It's like you're advertising for
I'll change the background here a little bit.
No, it's okay. That's
Right?
great.
I try to stay nice and white, but thank you. So my question is in terms of where do you see the economy going? And not the economy, but the market. And the reason why I'm asking is because I know for a fact that we've had, let's say, 4 or 6 recessions, dating back to the early 80s. And it didn't always necessarily mean that prices were dropping. In fact, the last 2 recessions that we saw where prices were a little bit negatively affected was The latest one was 2008, right? But that was caused by, faulty mortgages and not being as thorough or as thorough as we should have been with qualifying, buyers and things of that nature. It was caused by the mortgage meltdown, in my opinion. Do you really see that if there is a recession and it's hard to say where we're going? Obviously, the prices of gas are going up. Cost of just everything in general is going up, food, services, things of that nature. Do you really see prices being affected negatively, right? And you started our conversation with the one thing that in my opinion kind of dictates prices, that inventory is still low.
Right.
So what are your thoughts on that?
Yeah. As long as inventory is low, prices can't go down. They may not go up as fast. And so here's one of the things to think about. If inflation, let's say, I don't believe it's 8%. I mean, when I look at what things are costing me compared to a year ago, and I'm no mathematician, but geez, gas is up, 100%. And everything has energy in it. So everything I buy, now I see some things that I'm buying. I bought a piece of electronics yesterday for $295. That was the same price a year ago. But they made those things a year or two ago, maybe in China, and they're selling out inventory. But I see other things that I know are smaller and more expensive both. So hard to say what inflation is, but what I would imagine is we'll have inflation of, they say right now it's 8%, 9%, whatever, let's say 8%. And housing prices might only go up, let's say 5%, choose a round number. Well, a couple of things about that. Number one, 5% is less than 8. So you're going to lose ground in a sense if it's all cash. But most people aren't going to buy all cash. They're going to put some money down and leverage the rest. They're going to put down 30% and borrow at 6%. Well, if the house goes up at 8%, how much money would you want to borrow at 6% if what you're borrowing goes up at 8%? So for example, if I said, and this is what Wall Street guys do, how much Google stock would you buy if you knew it'd go up 6% a year, 8% a year, but only cost you 6%, you'd buy all you can. It's called arbitrage. Well, what if the house only goes up 5%? That's a little harder. But you're not borrowing your down payment money. That's going to go up 5%. So you lose a little ground there. And if the house only goes up 5%, your money costs is 6%, you're losing ground there as well. So I think that if housing prices are less than the interest rates, that's where you start to lose money by buying property. And people who own houses, well, I'm not going to buy a bigger house. I'll hold on what I have. I'm paying 3% interest. Why should I get a new loan at 6%? So that's why people won't sell houses. People won't buy houses as much because economically, why should I buy something that's go up at 5% when I have to borrow 6% to get it? And then the rest of the economy is going up at 8%. Can't afford to do that. So there'll be less buyers. But there's some buyers who will say, well, I want to buy a house. I want to live in a house. I have the money to buy it. I can afford it. Great. Nothing wrong with that. But that's not everybody. And so I would say that I think what you're going to see is less sellers will sell. There'll be buyers who will buy. But the sellers who have it are going to, more will hold on to houses. We'll have less sales. And that's why I think the real people who are going to lose this time are not the homeowners. The people who are going to lose this time are real estate agents who don't adapt to the new market reality, or investors. Now, if this is a side hustle for you, it probably doesn't matter. This is all I do. This is how I make my money. I make my money representing people selling houses, and then I take the excess and invest it in real estate to work for me. So I have to ask a question. I think, Hector, you and our colleagues have to ask the question, what do I do in this transition to make money, take advantage of the opportunity? Not because what we've been doing isn't going to work anymore, right? We all have a bunch of friends who have huge YouTube channels to get buyers to relocate to Nashville, Tennessee. Well, some people are moving to Nashville, Tennessee, but that business is going to slow down and get way more competitive. We have to think about how are we going to handle business in this new transition and make appropriate strategies that are going to work and help us create value for customers today. That's what I think. So I don't see prices going down. I think they'll go up. Housing prices, 3%, 2%. The more rates go up, the lower prices will go up. But I don't see them going down. I don't see that happening. In some markets, of course, but generally overall the country, no. What do you see?
Yeah, if we're throwing that out to the field, yeah, I am starting to see more houses listed there's more, I'm just taking pictures of more listings. They're starting to sit, a week, 2, 3 weeks, 4 weeks, depending on zip code and
Right.
that kind of stuff.
Right.
Also starting to see some price reductions.
Right.
The Zillow says it's supposed to sell for 2 million. And so they listed at 2 million and then it
Right.
sits 2 weeks. So they drop it. But to your point with the price and the gas, we are well above 8% because most people, okay, you and me are just, talking about our passenger cars. All of our goods, farmers and factories, they're on diesel. I mean, until an electronic tractor is invented, that's on diesel. Then from the farm to the distribution center, that's diesel. Distribution center to the packing plant to Albertsons or Vaughn's. Those are all steps of diesel.
Right.
So, yeah. And then in the chat, I threw San Diego's numbers in there. They kind of echo LA, except I think we've got a little bit more inventory starting to peak up, but prices is leveled down here in San Diego.
Yeah, I agree. I think that everything travels through gas and oil and diesel and related products, and it affects everything. And people don't understand that or learn the hard way. It affects everything. I had a client who I listed a house. I'm so disappointed who I listed a house with. They insist on listing $1,059,000, but from the day I started, we had a special. This other listing agent, they had some magic buyers list. I had a market for like a week, I think. I guess it says total 17 days, but 17 days. But they relisted already. They dropped the price about $67,000. So somehow they think by relisting it, the new number, it's going to new days on market, it's a new listing, it's going to sell. I don't know. I don't see that happening. But in terms of real estate value, that's because the house wasn't worth that amount. It doesn't, not because it fell in price. They saw a house that was bigger, so for 1.1, they wouldn't sell theirs for 1.1. But the bigger property is bigger, and just because you want that same number, it doesn't happen. And it's really sad. Okay, so Sean is on board. Matthew, you had a question. Is that what you want to talk about, Sean, or was there something else?
No, I was just chiming in on the fuel and the San Diego numbers.
Always glad to have you. Always glad to have your support. Matthew, I see your hand up. You have a question? You want to add in on the subject, or what do you want to do?
Hey, how's it going, Bill?
Great.
Thank you for having me on the meeting. I've been trying to get here for a cool minute, but never made the time, but today I made the time.
Yeah.
And I'm actually learning a lot because, I have been seeing the price increases, the market, all that stuff going up. So as a wholesaler, is it viable for me to be in the LA market? I'm also looking to expand virtually, but seeing as LA's populated, prices are pretty high, or the median price is pretty high. People are less willing to give a discount, less willing to sell their property at a discount. So I was wondering, you being like an expert in the field and all that, do you see wholesaling as a viable thing here in LA?
Yeah, look, I think that wholesaling will always be a viable business, just like real estate brokering will be. And one of the things, let me pull these stats up. I love these statistics. So when people tell me how bad the market is, I like data. Show me the actual data, and then we can have a discussion about where the market is and where it's headed. Let me see if I can pull this up real quick.
Okay.
But one of the things I ask is, well, what is a good market and what is a bad market? So if I said to you, in a good month in Los Angeles, in my MLS, which is the MLS.com, Greater West Side or Greater LA Area Association of Realtors, if in a good month we had 10,000 transactions, how many do you think we had a month in the worst month in 2008 or 2009?
If in a how many did you say?
If in a good month we had 10,000, how many do we have in a bad month?
Oh, okay. Probably half of that, right? Or maybe not even half, less than half.
You would think that, and I'm not saying it to call you out. I'm just saying
No worries.
to show you kind of where where we think and how it sounds in the marketplace. Let me show you guys a chart. And the MLS is a little slow, but
Was driving, so I didn't have my video put up. But
okay. Well, for people on the call, and I'm recording it. What I'm going to tell you is in a bad month, in the worst month of 2008-9, there were like 7,000 transactions. So from 10,000 to 7,000, which is not good, but it's only 30% less. Which means if you had to work 30% more, you'd make the same money. Meaning if you work 40 hours a week normally, if instead you just work 52 hours, you'd make the same amount of sales. It's not impossible. Psychologically, we all kind of buy into it. What really happens is in a downward market, here's the on the video of it. This statistic goes back to 2002. So it showed in good months, 12,700, and the worst month, this isn't right. Oh, homes for sale. I'm sorry. I'm going to close sales. There we go. This doesn't go back far enough. In a good month, we have 21,000. Now, in a bad month, we have less because there's seasonality. So you have to compare the same month of the year to the same month of the year in bad years. But if you go back in time, and this package doesn't go back that far. But the same month, if you compare it, you're going to find that in the same month, December to December, January to January, in a bad month, it's 70% of a good year. And so I think you can expect that whatever happens, you're gonna have to work 30 or 40% higher to get the same sale doing the same things, at least. One of the problems is so many people do the exact same thing and it doesn't necessarily work even in a normal market. So you have to make sure if you said to me, Bill, I'm new, I'm getting started, but your plan isn't proven yet. If you said to me, but Bill, I've been doing this for 5 years and I do 5 wholesales a year, okay, so you'll either do 3.5 wholesales this year, or you got to work better or smarter to get the same amount of money or more. But you have to, this is the time you have to review your tactics because things are changing and the same strategies that worked real effectively for the last year or two won't work given the current environment we're going into. For example, wholesaling, if I were you, and I'm a wholesaler, I would really brush up on subject twos.
Yeah.
I would really make sure I wise that because now more than ever, you're gonna have some people who own a house, want to move, think they can't because the buyers have to qualify at 6%. But if you know subject twos and you'll show them, no, actually, I'll buy it and I'll pay you blah, 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 blah. And you're assuming it at 3.25, you're creating value in the marketplace that doesn't exist because of your knowledge. And I think us regular realtors need to look into assumptions and subject twos as well. That's an old tool we haven't had to use, but the change has been so fast. We have so many sellers now with rates at 2.75 and 3%. And any buyer today is looking at 6% or higher. We've never had a 3% change like that, at least that I remember, in a few months. So those of us in the business have a chance if we learn those tools. And I don't even know what that all means. I'm still learning myself. What are the tactics? What are the inner strategies? If you're a wholesaler, do you know who Pace Morby is?
Yeah, I know Pace Morby. I try to brush up a little bit on creative financing. I just figured that I'd learn the base of it, the foundation, like thoroughly, and then I'd get into subject two. But I know subject two has a lot of potential right now. It's like really blowing up, right?
Well, it's not just blowing up. It's the market opportunity is being created for you, whether you like it or not. There's more sellers with rates at 3% who like to sell but can't because the buyers have to buy at 6%. If you can figure out how to make it work, you're going to be their hero.
So me as a wholesaler with a little bit of little to no money, right? How do I learn subject two? Because it's so hard. Like I try to put all the information together, on the internet. I know the basic concept of subject two, which is to assume the mortgage, right? Take over the payments, make sure it's on time, and build the seller's credit. I just don't know the contracts, the terms, the contingencies, all that stuff. But I have seen that it's a very, very good opportunity. Like you're saying, the market's being created, right? So why not jump into that opportunity? I don't understand, like, where can I go where I don't have to pay $10,000 to get this information, you know?
Well, so your question really is, how do I get started? And I don't
Yeah.
have money to invest. So in any
Yeah.
business, you have to invest one of two things. You either invest time or money.
True.
You get a return on your investment. You invest time or money. So if
True.
you don't have money to invest, you only have one thing to invest, that's your time.
Yeah.
So if I were you, I'd find the best people in wholesaling I could and snuggle up next to them as best you can.
Yeah.
And if you can't do it by joining, like Pace's group, I think costs like $10,000 or $7,000.
Mhm.
Number one, I'd watch everything he does for free first. He has more free content than you could ever keep up with. It's
Yeah.
good stuff. I watch it. I learn on it every time I watch it. And
Yeah.
then second, you might go to live events and meet somebody there's a wholesale and look for somebody who needs some help, and you're going to get a lower commission split or a lower deal, or you're going to make less money, but you're going to learn, put your time in to
Right.
learn the business. But you have to invest either time or money.
That's valuable. Knowledge is power, right?
Yeah, absolutely.
I don't want to take up too much of your time, but my last question is, I see that you're the probate expert. That's actually what I'm trying to get into as well right now. I'm learning a lot about the regulations here in California, and how probates work here, and kind of learning, well, not some more learning, but kind of strategizing how I would approach the seller as a human being, right? And show them empathy, compassion, and all that stuff. And yeah, man, what do you think? Is are probates good out here? I know it's a big population, so people are constantly passing away, unfortunately,
So it's a niche. I don't know that I would say to start in it necessarily. If you have no money to invest, again, then all you have is time. One of the niches, I'm looking for somebody who, time meaning you also have to lead generate. You've got to generate some leads somehow.
Generate leads, yeah.
You can either door knock for free, but that costs money now because you got to drive to get there most places.
Yeah.
You can phone call usually for free.
Yeah.
So I'm looking for people who, instead of bird dogging by going out house to house, who want to cold call, be part of my team to do what Pace refers to as gator lending or gator wholesaling.
Oh, gator
in
lending.
the probate space.
Yeah,
Specifically
like
the probate space.
For transactional funding, right?
Well, that's one type. And there's another type that's involved with probate.
Oh, with probates, okay. To pay off like the legal fees, I'm assuming.
Exactly.
Okay. Yeah, I mean, you say you're looking for people who are bird dogs?
Well, we're going to cold call. So I can give you a list of probate cases. Anybody can do this anywhere. Get a list of probate cases and call petitioners and
I'm down.
Offer them money if they don't have attorneys to advance for legal fees or other things. So if you want to call me offline, I'd be glad to talk to you about it, Matthew.
Yeah. How can I reach you offline?
Anybody can call me offline. My number 310-210-0008.
Okay.
310-210-0008. You should get, if you registered here, you should get an email from me. Just reply to that email or something. I'm sure I must send you texts and emails if you're on this call.
Yeah. I'll check that out right now.
I check it all myself. So just reply something there. That's for anybody here.
Cool.
Looking for anybody who wants to do bird dogging, phone calling, but it's cold calling. I mean, there's no, I'll just tell all of you, there's no shortcut. I started work today. My first appointment was at 8 o'clock. That means I sit at my desk about 7:45 and I work usually till 6. Today I'm gonna cut out a little early for a family event. I'll leave at 5. And I took an hour for an exercise for a walk.
Nice.
But I work every day. I'm on the phone nonstop, either on a call like this or phone calls, generating business. That's my job every day.
Any crazy people today?
I'm sorry?
Any crazy people today on the cold calls?
Not yet. Not yet. No, but I haven't been Zoom bombed yet. On my other call, somebody did Zoom bomb and I caught him right away.
Oh, yeah.
Yeah. I did another call at noon today, but yeah.
Awesome. Well,
Thanks,
thank you, Bill.
Sure. Yeah, reach out. Let's talk about. Just remind me when I talk to you about.
My thing died.
Remind me about the gator wholesaling. Okay. Good. Anybody else have questions? Let's see. So Dave Weineman wrote, "How do you raise your hand?" Dave Weineman, you raise your hand. I'll just catch you here and see. Dave, ask to unmute. Unmute yourself and jump in.
Hi.
Hey, Dave, what's up?
Thank you, Bill. Hey, you know what? Lots of interesting perspective here, comments. Everybody has their own unique experience in life. And I wanted to go back, if you don't mind, to one of the items that you were talking about a little bit earlier, Bill, about the 6 to 8% interest rates potentially having an effect on buying
Whoa. I said 6% interest rates. I didn't say 8%.
Okay, well, let's call it 6%. Let's call it 6%.
Okay.
So 6%
Might be
interest
8%
rate.
tomorrow, but it's not yet.
I have my own, I think, well, we have an election coming up. So I really think that by the fall and the end of the year, these interest rates will be a little bit more palatable than they are now. But presuming they stay at, let's say 6%, and you were making the suggestion that, it's possible that someone might look at that and go, you know what, my value of my house is going up, or value of houses is going up maybe lower or at that rate. It's all either a push or maybe even a negative for me to, try a different, go into a different house, sell what I have, and then have a 6% interest rate, let's say. I would submit that under normal circumstances, that might be correct, but I think there might be an exception here, and that is that the inflation is at such, I believe inflation is just we're at the beginning of the tsunami of inflation, as I said in my text or in my chat. I think inflation is going to get a lot worse before it gets better, and therefore the pressure on house prices of everything, including houses, will exist. And so I think that might happen. And number two, I think that the other part that I think some of us might be aware of and maybe not talking about with respect to the change in our economy is technology. The advancement in technology, computer systems and so forth, the delivery, for instance, of goods and services. Well, goods, let's say, Amazon has, they're going to be delivering goods through, small little helicopters, delivering it to your front porch, instead of having human beings, which is the way our economy, is a lot of our economy rests right now on human beings doing a lot of that manual work of, let's say, driving the trucks to deliver the goods to people. And so not only will we have airborne delivery, but we're also going to have likely automated driverless systems in the delivery trucks and so forth going forward, faster than I think a lot of us may realize. So anyway, I'm going to get off my high horse and I'll shut up.
This has been a debate. When I was in high school, there was a book called Future Shock in 1970, I think. And it talked then about the challenge of technology versus humans. And this has been a debate that's gone on for 50 years during my lifetime. And on one hand, people said the technology, and this debate's gone on actually since the Industrial Revolution, since the 1800s. On one hand was, well, if we industrialize, people lose jobs. And the answer is, yeah, but people become more valuable because they can use machines to create more value. And so that's why we're so much wealthier today. Today, I live greater than the king did in the 1700s. I have indoor plumbing, I have air conditioning, I have Wi-Fi, I have video. I have things they couldn't even imagine if you were the richest man in the world, 100 years ago even. So that's a debate. I don't know. I don't know if I'm gonna get into that. And that's still I'm 63. I don't know how much longer of all that I'm going to see. But what I would say is today we already have changes going on, rapid changes in people being laid off. In some of these companies, some of these tech companies. That this is all new. To go back to the subject of what I call subject to, which is buying a property where instead of the buyer getting a new loan, there's different ways to buy properties where you use the seller's current loan. So might have a house that's worth $1 million. They got a loan on it for $700,000 when they bought it or when they refinanced. And so rather than getting a new loan, there's ways you can take their loan over. So George asked the question, how does the seller protect themselves if the subject to buyer stops making payments to the mortgage company? Well, that's always one of the issues. There's two main issues. One is who makes the payment and how am I protected? And the second is what if the bank forecloses? Because a lot of most notes today are written such that if the bank finds out, they're going to start foreclosing. And so these are the key challenges. There's different ways, there's different answers. And rather than answer it, I don't do it for a living today. So I think I know an answer, which is, the seller can protect themselves if there's a third party where the servicing's done online that they both have access to. And there's a contract that's written with penalties and money and such that protects both parties. It can be done. And the same thing as far as, well, if the bank forecloses, there's actually companies that do insurance that will step in and pay off the loan in case that happens. That's a new development. So But I think the important thing to think about, George, is not how has that business been done for the last couple of years when subject twos were very rare. I think you're going to see subject twos explode in popularity given the disparity in rates. And so there are people who are asking those questions and solving those problems. And if you can solve the problem and present it to a customer, that's how you get paid. So good question. I think you're on the right point. I don't have an answer that I could convince you to sell your house with me today. But when I do have that answer, I'll be getting houses sold and getting paid for it. Hector asks, who do I watch? I'm not sure what you mean by that. Who I watch for what? Thumbs collateral. Thank you all. Loan modification. Due to diligence, I'm working with a broker to figure out the current market value of property in order to make an investment. I'm sorry, I don't see your question there, Stephanie, but we still needs a lot of work. Yeah, I think you're right. It needs a lot of work. I think if you figure out how to solve the problem, you will be, try more private messaged. Okay, got it. Boy, a lot of discussion in the discussion group today. I'm sorry, I didn't mean to step into. Will the seller be able to qualify for another house if they have the previous house active? So that's another good question, George. If you sell your house subject to, there's still a loan on your old property, maybe in your name. How do you qualify for a new loan? And again, these are problems. If you solve them, you get paid. So one is if you have a servicing going on, there's companies that will service those payments and give both parties access. When you go to qualify for your new loan, there are lenders who will look at 12-month history of payments and accept that you're not liable for the payment. Standard Fannie Mae guidelines allow, if you can prove you're not paying it, you have a contract that you're not responsible for it, Fannie Mae guidelines will allow that loan not to count against your ratios. So that's another, but again, I'm not saying I have that product and solution. I'm going to sell your house. I'm saying to you, I'm letting everybody here know, this is what I'm working on right now. This is the area that I would be an expert in going forward for the next few years, is learning subject twos, insuring subject twos, loan servicing subject twos. I think it's going to be a big opportunity for us. Okay. 346. Any last questions? Anybody here on the call tonight going to the Jewish Federation Real Estate Conference, real estate banquet tonight by chance? Anybody going? See, and then George says we have to ask some reserves in case they stop paying. Yeah, again, all that's negotiable. I think, George, I think you're on the right point. I don't have all the answers. I think you're asking the right questions, and these are the questions we need to answer to get paid. I think. So if anybody's going tonight to the show, you are. Oh, she has a question. If you're going to the Federation dinner tonight, I'm going to be there. My brother-in-law is actually the honoree. Cheryl Williams, what is up with your hand up? Let's get you unmuted.
Hi.
What's
Finally
up, lady?
back in.
Nice to see you.
Thank you. It's nice to be seen. I just sort of have a random question. Maybe you can answer, or maybe you can direct me. Can a person get a loan modification if they've been served a notice of default or they're in pre-foreclosure?
So loan modifications normally refer to a lender making a modification to the original terms of the note.
Understood.
So the time was that lenders would regularly seek to avoid foreclosing, and one of their common practices. And the government created all these different programs to encourage them, and they were graded on how many they avoided foreclosures with. Now what happens that I see happening is there are companies that have been created that all they do is foreclose. They're like fancy law firms. And so they buy the servicing, which is really BS. They really are just, the lenders just assigning it to their legal department. Because typically these big ones, all they handle is one company's foreclosures, and they just race to foreclose as fast as they can. So I don't believe currently we have the government bailing out lenders for loan mods. Therefore, lenders, I don't think, are doing it that I see in the numbers they used to do.
So if someone says that they're getting a loan modification, are they confused? Are they being bamboozled? I mean, what is one to think about that? Because I'm like, I thought that if you've been served a notice of default and you still haven't cured it by the time it goes from notice of default to pre-foreclosure, because that's a threshold. Those are two thresholds, aren't they? Like, kind of, you get to a point and there's no return. So
I can't speak generally, for all circumstances. And it sounds like George is right. There's NACA, they do loan mods, and there's also, Stephanie's right. Also, there's other ways, but that's not what I see happening today. What I see happening in the majority of cases is, for example, recently I had a client who had a loan with Quicken. and they got a letter saying, oh, well, we're quick and we really care about you. We love you. We're very kind. We're very this, very that. Looks like you're behind your mortgage. Please send us a letter explaining why. And if we have a good explanation, we'll extend things. This was somebody who died. This was a state probate I was dealing with. And you have until whatever it was, March 25th to reply. And so the client was all concerned and had the attorney write the letter. Of course, the attorney charges their time. And I kept saying to both parties, they're not going to even read your letter. If they say they went to by the 25th, trust me, the 26th, you're going to get a letter from the servicer saying, hi, we're foreclosing. Here's your 90-day notice. That's exactly what happened. So maybe things change, but as of today, what I see, Wells Fargo, Bank of America, Chase, Quicken, they just sell the servicing or sign the mortgage to another company. And if you research that company, all that company really is a bunch of attorneys, and all they do is file notice of defaults and trustees sell information and foreclose.
So this
I
lady,
don't see everything, but that's what I see.
so she may or may not be getting a loan modification. She may not understand what the dire situation she's actually in. And I don't know, because when she told me that, I was just surprised, because I'm like, I thought that they don't really, you don't get a loan modification when you're behind.
Is it in writing? Because that's the other thing. People hear what they want to hear. And I would say, well, good, put it in writing then. Well, they say they can't send a letter out. Well, trust me, if they're doing a loan mod, they'll send you a letter explaining what they can do. There's pages of disclosures. So put it in writing. Great, we can talk about it. But
maybe she did get something in writing. I didn't really inquire as to that. I didn't go get that far. But yeah, I was just curious because that just sounded wrong to me. Like you can't really get a modification if you're in default.
Yeah. I'd say there are probably loan mods being done. I'm sure there are. That's just not what I'm saying.
There's some, okay.
Versus they are. So again, it depends where you're at, but it doesn't matter what everybody else is doing. It only matters what your client's doing, their lender for that loan. And that lender could have 50 million loans and loan mod all the rest. But if they're not willing to loan mod your client's loan, then there's no loan mod option for them, I think, today.
And they should get out and sell as fast as possible.
Well, I don't know about that, but maybe they could refinance, they could borrow money. There's different ways, there's different options, but I don't think talking to the lender while the clock is running is a smart option for most people. Okay.
Oh.
Like I said, I just think they run the clock down and they file the notice anyhow after what you talk about.
That's kind of what okay. Yeah. So she doesn't even realize what's happening. And I'm just trying to help her save herself. This one prospect, it's just like,
that field is very regulated. If they're going to offer a loan mod, we're talking about, they're going to send her something in writing to clarify it and disclose it.
Yeah.
So, again, if it's in writing, great, then read what's in writing. Otherwise, probably not. And my experience with people who are behind is they're often just delusional. They hear what they want to hear. Up until the day I've been at sheriffs taking properties, up until that moment, I was on the phone. The lender said blah 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 blah. No lender said that. It was a sheriff's sale already. We're past that point.
Seems like there's a little bit of that going on in my mind because I'm like, do you realize the clock has been ticking for longer than it should have? And at first it was just a notice of default, and when I looked at the public record again, it was pre-foreclosure. So like, I don't know.
Denial is not just a river in Egypt.
Apparently not. Okay, well,
Okay.
thanks. Okay.
Kevin has a good warning. Kevin's a title rep and saying that you should hire somebody independent. That's interesting because there was a time there were some good ones and 90% were bad, but I think today most were bad. So
yeah.
Okay. So we got one last question. Anybody else have one thing they want to talk about? We'll wrap up here. Last questions in the chat box. BK's last option. Thank you, Kevin. Yes. Kevin Russell, Commonwealth title, great asset to have around. And bankruptcy is an option. And of course, it depends on the case and how much equity there is. Bankruptcy will protect your homestead. But the laws have changed so much on foreclosures. It's so hard to foreclose now that most people, if they look at their options, they shouldn't even have to go to bankruptcy, I don't think. Okay, and no other question. I think we'll wrap up then. This was good. I'm sorry that I had a guest and I thought he'd be really great, but just didn't quite work out. But hopefully answering questions was helpful. And we'll have to do this again sometime. I'm Bill Gross. This is our Tuesday real estate investing zoom.com. We get together every Tuesday at 3 p.m., 6 p.m. Pacific time. talk about all things real estate investing. We're going to be focusing a little more this year, I think, on multifamily investments, as limited partnerships, investing out of state, and wholesaling. So if I can help, my information in the chat box below. Thanks for all participating. Really appreciate you guys, and have a great week.
Okay.
Talk to you soon.
Okay, thank you.
Thanks so much, everybody. Appreciate you.